Right, hello everybody. That was me doing a Lulu impression in the room next door to get everybody to be quiet and come in. So we're going to do a quick 30-minute session. We're actually going to try and do it in 20 minutes and open it for Q&A, because every time we've done these before, we find that there are actually more questions than normally can be accommodated. So the whole objective of this session is an extension of what we did in the keynote this morning, which was talking about what is climate risk, how to simplify it, and how to get it into mainstream finance. So this is where traditional and sustainable finance converge. It's David and me. David Kelly is my colleague. He's our Chief Science Officer. I lead all the market-facing work, and our third colleague, Fergal McGovern, does all the operational implementation for the business we do. And we're members of OS Climate. We are co-partners with BNP on the physical risk, and we're going to take you through the challenges of getting physical risk into the systems of mainstream banks. Okay, so here's today's fun-packed agenda. We're going to explain who OS Climate are and us. We're going to have a little bit of a vision of what the Physical Risk and Resilience Project is, PRR. We're going to talk about the catalysts, because if you did this 5 years ago, you wouldn't have any traction in the market. And we're also going to take you through why residential real estate is a really good place to start. And from that, how to get into practical implementation and some takeaways. Okay, so I'm going to lead off. Both David and I have long careers in banking and in hedge funds and other financial services. We're both mathematicians, but we know how to run businesses. Physical risk, we got involved because of one simple thing. We want to revalue the assets. We don't want a rerun of 2008. We want to make sure we've got the right data and the right models to do it again. So you've heard about the big green short. It gives everybody a context. Everyone knows what the big short is. So when you talk to people about climate risk, they glaze over, it's complicated. The big green short is a really simple way of people understanding what it is we're trying to do. So what's OS Climate? You know, it's a Linux Foundation project. It's merged with Finos. Everything we're going to do now is going to take the Finos excellent projects, and we're going to leverage them to get the climate risk capabilities into the end users. And that's end users in both lines of business and group functions. And I've put in here, I'm not going to talk to the slides through this. We're going to talk over them. But this is a resource deck. So afterwards, you'll all get the deck, and then you can go into the warren of the internet and the links. But we're going to try and present through this how you can rapidly get into the integration, okay? And just to give you the context, why is physical risk a big deal? Well, 200 years of climate research is behind a lot of this. There's 30 years of the United Nations, but it all happened 10 years ago with the Financial Stability Board and TCFD, okay? So this is a really simple representation of a bank. It's got pillar 1, 2, and 3, reporting, analytics, and risk. Pillar 1 takes you right up to capital. Nobody's solved the capital adjustment valuations yet, and that's what we're aiming to solve here. There's two firms running it, BNP and Paribas, and we're now extending that to a whole series of other participants from Finos and members of ISDA and the wider community of commercial vendors. Here's the catalyst for timing. We know regulation is ubiquitous, but what you may not know is there are two Basel Committee standards. One is the original risk aggregation, BCBS 239, but the other one is a reflection of that, a mirror image for climate risk. Now, this isn't a local regulation. This is for all banking regulation. So these are the standards that determine capital and how you integrate new risks into those capital calculations. So most people will never have heard of BCBS 530, but it is the most important guidance on how to integrate this. And this ends up as legislation in each country, okay? And the objective here is to standardize climate risk disclosure and get to revaluation, okay? So we're gonna lead off with David explaining why residential is the right place to start.
Thank you, Johnny. everybody lives somewhere. And I think with residential, there's a couple of good easy things about it. A, it's big, and B, it's highly indebted. So the US, $19 trillion of stuff. And, you know, it's somewhere between 50, I think in the UK, it's somewhere between 15 and 19% of houses are at flood risk. And I think in the States, about the same, about 17%. So that's, I don't know, that's about 1 in 6, isn't it? 1 in 6 houses are at risk of flood. And we're not talking about those in swamp plains in, you know, just outside Miami. You know, it can happen, as I've heard talking to Stephen here, that it can be in the mountains and stuff like that. And if anybody's been looking at the news recently, Asheville, North Carolina, I would say that 100% of properties have been fully damaged. So this is a current, and you know, it's a very tactile problem that we're looking at here. It's not something that might happen in the future or could have, should have. It's something which we can see on the television, and I can tell you when it happens to yourself, you'll certainly know about it. So I think it's got a real presence about it, which I think is extremely concurrent.
Okay, forward.
Yeah, go ahead. So just on to what we've been doing in open source climate. And you know, the ultimate here is that we converge into the Financ componentry, but obviously that is early days. So we've spent a lot of time getting the data together. There's been, in this world, data is this is public data, extremely fragmented, and you need a way to ingest it and curate it such that it is at least useful. So in parallel to that, we've been working with geospatial, you know, satellites, and you know, working with hazard indicators, which are essentially floods, wildfire, coastal damage, droughts, et cetera, et cetera. And there's an extremely long list. On top of that, we've started integrating third-party data, and that's been, you know, the public data is quite useful, but the proprietary data or the third-party data provides a lot more granularity. And in some places, such as the groups like Airbus, you know, you're down to, you know, less than 10 meter square pixels, which is absolutely perfect for this. Kind of in parallel, we've been working with BNP Paribas to sort of start building out the model library. And that is very much centered around hazard curves, which I'll show you an example of in a sec, and vulnerability curves, which are, you know, the potential for losses on a particular building, whatever, as a function of flood depth. And the latest thing that we've been building is a portfolio loss simulator, which is now translating impacts on individual properties to the actual loan that is backed by, or the property is backed by a loan. And that enables a lot more interesting sort of financial type of scenarios. And then towards the end, to the top of this list, we're starting to look at mortgage-backed securities and obviously capital calculations. But we'll come back to that one later in this presentation. So this is the sandbox in OS climate, and I don't know why I chose New Orleans. It's probably unfair, but this is quite interesting. It gives you a sense what a hazard curve actually is. It's really a depth, estimated depth, based on a frequency of that thing happening. So a 1 meter, let's say 0.9 meter here, is around about a 1 in 50 year event. And that's a sort of very much a sort of an insurance view of the world, which we're now translating into much more of a capital markets view. And this one happens to be using an RCP scenario, and it's obviously a future year. So we are looking at hazard curves out into the future based on different RCP scenarios.
So do you want to just explain what an RCP is?
It's the representative pathways that the IPCC has created, and there's various organizations, NGFS and groups like that, who then translate these sort of climate-related pathways into floods.
So essentially what we're doing, David, is we're taking academia, which has been a really good guide, but we're now actually translating it into quantified practical solutions.
Exactly.
And there is no such solution in the market today off the shelf. And that's why this is such a good cutting-edge project. So I'm going to talk now about the foundations of what everyone's had to do in finance. It hasn't been to calculate these more advanced quantitative measures on capital. It's much more about reporting. And reporting's been the bane of the market. We all report individually, we all build our own taxonomy models, and there's no collaboration. We want to end that. We want common taxonomy models. We want every time there's a new regulation for all of the members of open source to collaborate on an open taxonomy model. We started that on a project a few years ago. We got funding from the UN, the Irish government. We put some of our own money in it, totally with no profit in mind. It's called Open Source Sustainable Finance Taxonomy. We were supported by Red Hat and a bunch of others. That gave us the catalyst to start thinking about how the entire market can collaborate on common taxonomy models. And this feeds directly into the traditional finance of Finos, because we've got that already. We've got under Jane, we've got Open RegTech, and we've got CDM. We've also got common componentry. You know, we've got TraderX, we've got a whole other bunch of things. We've got FDCC3, and we've also, excuse me, we've also got a whole backlog of new projects, okay? So our approach ultimately is going to take us into the same as traditional finance, and that's about risk transfer. It's no good if you find out you've got a load of risk if you can't do anything about it. And for those who have the knowledge of the past, it all started with interest rate swaps to transfer that risk, then currency, then CDS for credit. Now we're going to get it for physical risk. And it's going to be an enormous market, probably one of the biggest and most lucrative markets for the entirety of the financial system. Okay, back to you, David.
Yes, this is just a simple example. This is Bristol, which is my alma mater. And we've just been sort of playing around with a UK mortgage provider that gave us a portfolio in this area. And we've linked it in with flood risk potential data, but also there's a whole ton of mortgage and property-based information. So this is it's quite a simple exercise, and it's really part of the disclosure reporting components of this. But it's starting to give a sort of visual of clusters of issues. So this sort of, you've got clusters of reds or ambers here, and they're based on sort of fairly rudimentary scoring. But it's the first step in pointing the user in the direction that they need to, have a look at these properties in a bit more detail. They do, if we do click on these things, you can actually go and have a look at the satellite imagery of that particular property. And you check for things like, what sort of resilience, like it's called a wall, to protect them against any sort of flood protection. So this was sort of a project which, as you said, that we proved out with a major mortgage provider.
And we've done this in multiple locations to make it relevant to the audience. We've done Florida, we've done a little bit in California and Texas. We did Ireland, we're now looking at Portugal, and we're also doing the same in Spain and Italy. And what's interesting about this is that this is taking non-financial data, linking it with the balance sheet, and giving you a visualization. So you can switch from a grid, which is quite popular for people to use, for data scientists, and then you can switch to a visualization, and then you have other topological views you can actually augment. So you can bring together all different series of scenarios. This just happens to be for flood, yeah?
Correct.
Yeah. Right, David.
So this is a bit...
before you say it, this is the real quantification that nobody's yet solved. And it looks Mickey Mouse, but I think it's beautiful. It's art. It's art. Risk is art. It's also a piece of code that we are going to donate to the OS Climate, something which we've been building. So if you can imagine what we've been doing, we've sort of started the back end of the risk process. We've really focused on
disclosure reporting, and we've done some, as I said, some rudimentary stuff here. Now we're sort of moving things up, it's the value chain, if you want to call it that, and building tools for the risk department. And what we're doing here is we're taking a property over sort of a 20-year horizon that, so obviously is backed by a loan, and inserting 2 flood events, and then sort of creating the way the value of the property will change because of a flood, but actually does recover over a period of time. And then obviously gets hit by a second flood, and off we go. The loan itself trades kind of below par, based on the fact that the property now is trading below the outstanding value of the loan, and the actual overall affordability of that loan has gone up because you've got additional expenses, including insurance. So this is just a way of you can imagine a risk department aggregating this across there, and then having a sensible discussion around what type of scenarios or how frequently do we want to impose floods or clusters of floods on a particular portfolio. So this is just hot off the press in terms of a proof of value. And as I said, we will be donating this to the OS Climate.
Okay.
So, but you've got, so I think if we can move to the next, this is quite, it looks like a lot of squiggly lines. I couldn't think of a better way of doing
There's something we should highlight on this. People know most climate risk is 80 out to 100 years. Anyone see the axis? We're looking at risks in single-year digits. Banks care about 5-year risk because that's the basis of their credit models. 50-year risk is no use to a bank, to its regulator. So that little bit of difference we've achieved of starting to analyze in the 5-year window is really material. And again, nobody's doing this except on this project, as far as we're aware, and it's possibly being done in some of the secret vaults of some individual firms. So if we go back to sort of what we've been talking about, so this is something which we started talking to, I think it was initially with Fannie Mae, and we've had exploratory conversations with the Morgan Stanley team at TraderX. So we've started with, as I said, the back end doing sort of peril vulnerability curves, which is damage as a function of flood depth, and we've just shown you sort of how we can revalue the loans. Mortgage-backed securities is quite sensitive to macroeconomic things. So OS Climate also has a integrated assessment model, which then does all that modeling for you. So we're going to combine those three and hopefully work with the TraderX team to start doing MBS type sort of shock generation. And with any luck, with the eventual bank sponsor, we'll plug that into their instrument pricing. So the reason for this is really to put flood risk into the first line of defense. I would imagine initially with researchers, but also with originators as well. The reason why we're doing this is because once it gets into the first line of defense, you stop internalizing this risk and you start to look at the opportunities to offload this risk into as Johnny mentioned, into a CDS type market. So this is very leading edge in many ways. But we believe that the combination of the componentry of OS Climate plugged into the FinOS componentry, I think is the winning formula here. Okay. There you go. Oh, it's me. So, in a nutshell, we think we're solving something which has never been solved before. We'll solve it even faster if we get more participation. The way we're trying to do that is to break the whole project down into components. And each component can then be worked on as a sub-project. So people can then, who don't have huge amounts of time or understanding on other things, can actually contribute to this project. So it's been led by 2 firms, substantially BNP, now BIP, but we've spoken to already a dozen firms, financial firms, and more than 20 third-party specialist vendors. So we think they're all going to start contributing It's going to be quite dramatic when we get commercial vendors contributing as well, because you're going to have a sandbox which is almost like something you can only build after you've got a trial license with a vendor. We're recommending to everybody, don't lock down your commercial reference solution. Start with something quite flexible, like a technical architecture reference solution. Reverse out of it what componentry you think you could collaborate on. Come and talk to us, and what we'll do, we'll figure out who else is willing to work on that componentry. And that way, we'll accelerate the point solutions, and then we'll fill it out just like painting by numbers. We're going to leverage everything in Finos. We've already got plans for FDC3, CDM, TraderX. As of this conference, we've probably got another 5 candidates.
Yep.
There's Morphere and everything else. But number 5 is pretty important, the ISDA standards. As David said, the market's been quite introspective. It's very much navel-gazing. We're obsessed with board-level policy, passed down to teams, and regulatory reporting. But once you start discovering what risks you're running, you're going to have to transfer them. You can only do that if you've got a counterparty on the other side. And we know from the other risk transfer markets that those counterparties are either other major capital markets, banks, brokers, or the reinsurance industry. So one of the things we're seeking to do with ISDA is to create 10 to 15 of the major capital markets firms, 10 to 15 of the major reinsurers, and to define the first ever 5-year physical risk flood swap and make that the benchmark. We're going to do that with ISDA Create. We're going to push it through CDM. We're going to push it out to an MBS desk. And this is going to be transformational. And that's the aspiration here. So we ask for your collaboration. And if you don't know who to talk to, you can remember David's very bright shirt and my very dark jacket. And you can talk to anyone at Finos and anyone at OS Climate, and they'll put you in touch with the right people. Finally, we got an appendix. These are all our thoughts. We've posted everything on LinkedIn. Our whole approach is to open source any idea we have. You just go to the big green short, # the big green short. David, do you want to talk about navigating the repositories?
Yeah, it's all the GitHubs really around OS Climate. There's actually some good coding and obviously documentation, a few how-tos. The good news is that at BIP we actually had a go and adopted it for a UK mortgage provider. So it's pretty good. Pretty pleased with it, to be honest. And as I say, the coding and the modeling is particularly stable. The white ecosystem, oh gosh, look, there's TraderX. Funny that. But also we're looking at Climax, and Oasis, which is a similar thing, but in the insurance markets. And right at the bottom, we have the actual the proof of concepts that we've been working on.
We believe that's going to be the first commercial application of this open source, ever by BIP.
Yes.
So.
One final thing, and this is sort of a bit of a word of warning. Climate modeling is extraordinarily complex, and also it's a stack. What I mean by that, you've got models feeding into other models, and you have a varying degree of complexity, accuracy, forget bitemporal, and it's tough, right? So just simply taking a third-party, flood results and whatever, and thinking you're going to get it through model governance, good luck.
How about not a hope in hell?
That'll be a more accurate statement. Thank you, Johnny. So the part of this is actually to work within the industry. My background is model governance. That's why I'm talking about it. Really is to make sure that the model stack is really understood. There has been a tendency in this space to grab data and believe it's real, and then to try to persuade risk decision makers to use it. That's I would say that there's been a pushback on that in certainly this year. So within this, and I think this is, we've heard a bit about this the last couple of days about AI governance and stuff. This is equivalently an important component. So I'm just going to say on that happy note, I think we are now open for questions.
Yeah. Model governance, everything that they talked about on the panel, Kim Parado was very eloquent on that. So thank you, and any questions? Bingo.
Hello.
Awesome.
Correct. Yes. So you're absolutely correct. The condition for a mortgage. Oh dear. You okay? Standing on.
David's going to answer every question.
So yeah. So you're right. So the condition of getting a mortgage is your property is insured. So we have a maturity mismatch issue here, or a stack and roll, if you're a commodities trader. So the issue is that you have to roll that insurance every year. And one of the things that we're modeling is that when you do have a flood, it's unlikely you get full coverage from the insurance, because it's just, life's not like that. And secondly, your insurance goes through the roof. So, and if you have a cluster, so this is why your property value will go down, because if you try to sell it, they'll look at the insurance, and then they'll have to discount the extra insurance through the life. So that's why you get a drop. If that flood happens soon after, then you become risky to the point of being uninsurable. So if you have an asset like that, you can't sell it because nobody else can buy it.
And there's
on an insurance.
There's a very important point about end users, end owners, don't have access to sophisticated insurance either. And we've been looking at how does a lender actually cluster their portfolio and go to a reinsurer and insure on behalf of the borrowers, because the borrowers don't have that wholesale market capacity. And then they pass on the cost, but it's far lower than it would be for the individuals to do that. That's coming. And we've been working with one of the leaders in the UK market to advance that, and with the Bank of England.
Yep. But you've hit on exactly what the problem is.
Yeah.
If you have a mortgage owner who can't insure their property, the most likely thing they can only do is leave the keys and leave. Yeah. And it's the lender that holds the bad asset. It's not the insurance company.
Now, yeah.
Yes.
But we got to take other questions.
No,
can we just pause?
It's a good question.
We're going to take the other question. Sorry, we will come back to talk to you afterwards. Can we take the gentleman's question in the middle, please?
Yes, no, absolutely, yeah. Yeah, thank you for pointing that out.
Okay, thank you. Any other questions?
I've got to go back to the curve thing. So
you're going to wind up, are we, Rob?
It's okay. 30 seconds on the curve thing, right? So the curve thing is particularly London and UK dynamic. So people forget. It's really that simple. People forget. And the average time for property value to recover is about 5 years. And it's a bit anecdotal, but and maybe that's because in the UK we have limited housing stock. Yeah. Whereas where you can expand, I can imagine that the recovery be either non-existent or much slower. But yes, it's really highly dependent on the locality of of the housing stock.
So if anyone has any questions and you want to get to us easily, go on LinkedIn, go to the hash, the big green short. You'll find David and me. There's a whole history of our research, etc. And you can get to us that way and ask anyone at Finos, ROS Climate. Okay?
Great.
Thank you very much.
Thank you.